Okay. Well, thank you, everybody. We have a great list of attendees. Really appreciate you taking the time to join us. We have a lot of great content that we're going to be going through. And before we begin, there's also going to be the Q&A right below at the bottom of the screen. So if you have any questions during the presentation, please submit and I'll be able to ask Tom and Dan either during or after. And then at the end, during our fireside chat, we'll absolutely open up the Q&A if we have time. Otherwise, we'll be still using the submissions. So again, thank you, everybody. Let's get to it. So first, I'll introduce the team, then we'll go through the cash flow maturity. From here, we'll go into a demonstration, and then we'll go into the fireside chat. So our presenters, myself, Sarah Katz, I lead our US markets, and we also have Tom Munley, who's going to be providing with his experience in private equity, working with multiple different industries around liquidity and cash flow. Dan Meyer will be presenting the Anaplan 13-week cash flow and walking you through all of the possibilities of how to quickly stand up the solution in weeks that you're able to start answering questions that with everything that's going on in the uncertain times. So a little bit about Spaulding Ridge. We started this organization about 2.5 years ago, and the vision was really around best in cloud. And actually, all of the technologies listed below, we use internally as we have been growing so quickly, because we truly believe on that digital touch and being able to have the data and being as efficient as possible. With that said, we're almost about 170 people plus all over the world. We have locations in Canada, US, Sweden, UK, France, as well as the Philippines. And one of the things I will say is, while we're talking through the cash flow, we're also thinking about what are the different data points and information that is necessary, and how do you really integrate with your different technologies. So from here, one more thing before we jump into the cash flow. Is really around the honeycomb Anaplan connected planning. This is just every organization right now is trying to pull different information from their different departments or functions. So within a cash flow, if you think through, or your finance team, they need to really have appreciation of what does my sales and revenue look like? What is my cash collection? How risky are my customers? What does my balance sheet look like? What do I owe to the banks? All of these different questions. And Anaplan really allows you to integrate with all of these different planning activities and looking at from a financial as well as an operational viewpoint. So the flexibility is absolutely there and allows you to change very quickly as we realize that we need to during these times. And so from here, I'm going to introduce Tom, and he's going to walk us through the cash flow maturity curve.
Thanks, Sarah. So one thing before we jump off this slide, Dan, one of the things that I think is important to consider, and one of the big differences between cash flow forecasting today in 2020 versus cash flow forecasting, let's say in 2005 or 2010, is the availability of technology platforms like Anaplan, where you can actually pull information in to a single model that spans the organization. And so when we talk about cash flow modeling maturity, right? When we think about what's that evolution look like, we've basically developed the model which you see before you, which really kind of breaks down cash flow forecasting into three different views, right? You've got your short-term cash flow forecast, which is your traditional 13-week cash flow, which pulls in payroll, workforce payments, operating cash flow from AR and AP, and allows you to do some limited AR and AP scenario planning, right? Understanding what payments may come in, what payments can I hold back. And all of that is great, but that also only gives you a limited amount of information, right? It gives you a limited view of where you can expect to get cash in, where you can expect to control cash on the way out. From a maturity standpoint, the next step is what we call near-term cash forecasting, right? And that's actually integrating more information. So if you think about the honeycomb, which Sarah had on the previous slide, there was a lot of other boxes on there besides financials, right? And when we talk about doing a cash flow forecast, ultimately reaching your maturity and taking that next step goes beyond just doing financial forecasting. And that means I'm pulling in information from a couple different sources. First and foremost is my sales ops forecast, right? What am I going to get from my current pipeline? When do I expect those deals to close? When is that going to result in cash flow that's going to be generated? And becoming better at forecasting my sales and what does that translate to from an operational standpoint becomes that much more important. And what are we talking about here from a system standpoint? Well, we're talking about pulling information in from Salesforce. We're talking about pulling information in from Dynamics CRM. And all of that can be then translated into the same model, which I'm using on my 13-week cash flow forecast, so I can get, again, a better level of visibility, a higher level of maturity in terms of how I'm doing that cash flow forecasting. When I think also in terms of like the near term, one of the things, and unfortunately this is the reality of our economy today, is what's the impact of a workforce action, right? And what can I expect if my business trails off or if I see a decline of 15%? Like, how do I plan for that, and what's the impact to my cash flow? Well, being able to model that and go through scenario planning with Anaplan is something that we'll see on the short-term side in the demo that Dan's going to do. But in the near term, it's modeling some of those same workforce planning options, into a cash flow forecast to translate in all those costs, the burden costs, the salary, the benefits, 401k match, everything. What is the impact if I take action on certain parts of the workforce? And being able to model that in the near term is important. The other thing that we're seeing more and more of is, what's the result of financing activities? If I can increase my revolver, if I can extend my revolver, if I've got a situation where maybe, let's say I'm going to breach a covenant, what is the impact to my cash flow if my interest rate jumps up from prime, prime +1 to prime plus, 3 or prime plus, 7, to the point where you're going to be in pretty dire straits. And so when Dan gets into the modeling, you'll see that from an operational standpoint in terms of like, what do we do from a financing standpoint? But the important thing to consider as you consider your maturity around cash flow forecasting is, how do I layer in all these different data points to build a better view with a longer horizon for what my cash position be, and ultimately what my liquidity position would be as an organization. And then long term, and again, this is the once you've done the short term and the near term, you move into the long term, which is, how do I then begin to model additional sales capacity, right? Or potentially reduce sales capacity if I'm going to look at exiting markets, or if I'm going to look at entering markets. What does that do to me, both from all the things that you saw on the previous two steps in terms of payroll, in terms of sales ops, in terms of incentive comp, being able to model all those things out. Like, that's something that ends up being a longer term cash flow forecasting. Same thing from a supply chain perspective. If you think long term around supply chain, and we'll get into this a little bit more later on, what happens when I put a new warehouse in the US versus in Juarez, right? If I have to worry about crossing a border, previously not an issue. In this day and age, obviously it is an issue with the borders being closed, or at least severely limited. So some of those things are considerations that you're going to have to make as we think about what the impact is to cash flow of making decisions around supply chain investments. And same thing for organic and inorganic growth. What are we doing? Maybe we're looking at more acquisitions. How does that impact our liquidity position? And then lastly, what is the impact of either long-term debt or potentially issuing new equity do from a financing standpoint? We'll talk about that a little bit more. But each one of these is really helping to paint the picture of something that we can do today, which we couldn't do 10 or 15 years ago, which is to say, look, how do I begin to layer on top of each other, integrated sources, right, from either my CRM system, from my supply chain system, from my payroll system, all into one single model that gives me that visibility. And then, oh, by the way, how do I leverage things like scenario analysis to be able to figure out, okay, what are the impacts of decisions or actions I can take in terms of my liquidity position? So with that, let's dive in just a little bit more into the short term. So Dan, if we could hop to the next slide. When we look at what's kind of first and foremost, and I saw an article posted by a turnaround consultant this morning, and it just reiterated the importance of this, right? When you're running tight and when you're running in uncertain times, it gets down to the question of, okay, can I make payroll? Can I pay the vendors that are due? Will there be a disruption? But like all these questions that I've got outlined here on the right-hand side, these seem like very basic things, which in normal times and normal economic times maybe aren't as big of a concern. But when you hit a point where you're reaching a sort of economic uncertainty where you're not sure if your suppliers are going to be continuing to ship you product if you're not making payments on time, where you're not sure if your customers are going to pay you on time? And how do I begin to model the impact of maybe a single receivable, a single large receivable, that's now all of a sudden at 90 days or 120 days? What does that do to my cash position? And as Dan walks through the model that we built in Anaplan, you're going to be able to see, what happens when he says, okay, you know what, let's pull a payment in or let's push a payment out, what it does to the liquidity position for the organization. But all of this gets to, really what is the near-term impact on my liquidity position that I can expect from operating the business, essentially AR, AP, and payroll with being the primary things which impact your cash position on a daily basis. So any questions before we jump into the demo?
Thanks, Tom. I was worried you were going to keep flying through, and we have a few questions from the audience. So the first question is, really around how do you really identify where you're going to have more risk around accounts receivable or collecting cash, and how do you really look at modeling that or assessing it?
Now, great question. So, ultimately, the risk, and any good banker will tell you, the risk is inherent on the business of who's going to pay you, right? So, just like a banker would look at the risk of your ability to pay, say, a mortgage based on your personal income, we look at you should look at the risk of a customer's ability to pay based on their industry and based on how their industry is being impacted. So, to use maybe a somewhat painful example right now, if you think about retail stores, especially in states where there's a complete shutdown for all non-essential businesses, they're in a situation where, yes, they may not be able to pay at this point in time. So to be able to model out and say, okay, look, if retail is 20% of my business and I'm expecting that 20% is not going to be able to pay for some indefinite amount of time, what does that do to my liquidity position? So thinking through the risk associated with each customer, and then frankly being able to model and have a model that refreshes daily with updated information from your AR, your AP system, your payroll system, being able to model that to see what the impact is, that's the information which then allows you to make more proactive decisions. But it's definitely, looking at the individual risk of those customers. And when Dan jumps in the model, he'll show you a great example of how we can push a receivable in or out in terms of expecting to get that cash payment in, and what the consequential impact is to the liquidity of the organization.
Thank you. Yeah, that it's an interesting time, especially how we're reassessing each individual customer right now. The other question that we have is, what if that part of the business or function is outsourced, and how do you really connect that information or data between Anaplan model and a third party?
Yeah, so we've got a number of clients that work with ADP, right, from a payroll standpoint, and so pulling information in from an ADP or from frankly any outsourced provider from a payroll perspective, that's no different than pulling it in from a different ERP system. So one of the things, and we're not going to dive into not going to dive into the speeds and feeds of data integration on today's demo, fortunately for everybody on the call. But it is important to note that when you build a data hub within Anaplan, you can set up those recurring feeds and import those data using APIs. So it's a repeatable process that you don't have to worry about, right? And typically, yes, you do engage a consulting partner such as Spaulding to help with those sorts of things up front. But once you build it, that data will continue to come in and be refreshed. And so it allows you to focus on doing the scenario analysis and modeling that you want to do in order to figure out what actions can you take to make sure that your business is going to remain liquid, or proactively make sure that you need to maybe go from, okay, how do I manage my AR and AP to, you know what, I realize I'm going to need some additional help and start to get that financing lined up.
So that's great. Like, you can get that process automated and start really focusing on the things that matter. So really excited to see the demo. That's all for the questions so far.
Yeah, and just one last comment before I turn it over to Dan on the demo. I think it's, people will often ask, well, it sounds like what you guys are doing is essentially a glorified Excel spreadsheet, and it's really so much more than that. So when you look at the demo, obviously you're not going to see rows and columns like you would in a spreadsheet. You're going to see some data and some tables, but more importantly, you're going to see some drivers that you can change and make decisions on the fly in terms of seeing the impact. The second thing is Excel is inherently dangerous for a couple of reasons. Number one, somebody can take that spreadsheet and accidentally send it to their brother-in-law. They can accidentally leave a laptop somewhere. And so from a cloud technology standpoint, having Anaplan in the cloud, making sure that that's locked down, and all the security that Anaplan invests for all the clients that it has, like, you end up being the beneficiary of that, even if you're only doing or starting with a 13-week cash flow forecast. So with that, I'll turn it over to Dan to walk through the demo and get everybody to see the show. So Dan.
Great. Can you guys hear me okay?
Yep.
Perfect. Okay, so what we're going to do is we'll walk through kind of a day in the life of what your experience could be with Anaplan working on a 13-week cash flow. There are a lot of nuances within this model, but what we're doing here is looking at this from one user trying to create a user experience for that one user to be able to pull specific drivers throughout the model to be able to immediately see the results in their cash flow. Now, as Tom was mentioning earlier, what we're actually doing is bringing in data from multiple data sources. So bringing in our AP, our AR data, as well as our headcount data and our overall payroll data to be able to see what happens if we trigger each one of these drivers and assumptions throughout the entire model to see exactly where we can get our cash from and at what point in time are we going to need cash. We're looking at this from the least risk all the way through a high risk perspective. So we'll start at looking at DPO and DSO. I will go into there looking at our AR, to figure out what invoices we'll be receiving. And then lastly, as a last ditch effort, we'll look at trying to bring in, pulling on our line of credit as a revolver to see where exactly are we going to need funding at specific points in time. Now, looking at our model here, what we're starting to do is up top looking at our cash flow and quickly from a workflow perspective, being alerted to specific points in time that we know we're going to need additional cash. So if I look at my model here, not only am I being what was that? Sorry?
Sorry, you got to switch screens. We still see the demo slide.
Oh, my fault. All right, is that better?
There we go. Perfect.
Perfect. So everything I just said is still happening here. So as we're looking at our model here, what we're starting to look at is about 13 weeks out and what periods we're actually short on cash and what periods we have enough cash. And if we look at it specifically, we can focus on mid-June to about mid-July, we're coming up short of cash. And we're being alerted through this on our cash flow as well as on our workflow notification on the right side. So now what we want to be able to do is pull specific triggers within the model to see at what point or will we be liquid enough where we do not need to borrow from our banks. Now to scroll down, we can see this graphically as well, and we can see we have a decent amount of payables coming through early June, and that's really what's driving our cash shortfall throughout the next couple of months. So we want to be able to do is make sure that we're eliminating that cash shortfall on a weekly basis. Now, as our company, what we've already started to do is extend out some of our payments. So we want to look at some of our drivers to see what happens if we change some of these payments and what that impact will be across our model. Now, first, if we focus on our DPO, we can see we've already started pushing these out. So we're at about 32 days out with payables. Now, if we want to start to extend these, we know it'll give us more cash in the short term. And we'll have to figure out how we're going to be able to renegotiate these terms in the long term. But again, we're focusing on this from a short-term perspective. So first things first, what happens if we extend this out to about 60 days? Now we can see pretty quickly that if we extend our payment terms out to about 60 days, we'll start to alleviate some cash in the long term. Now we still have our pitfall in the middle, but we can start to see as some cash starts to flow in throughout July, being able to extend those payment terms and knock down that AP on a monthly basis, will at least a weekly basis, will at least give us some liquidity towards the end of the time period. And that's not enough to make it through these next couple of months. We want to be able to figure out what we can do on a weekly basis to make sure we actually have cash coming in at each one of our specific weeks in June as well. And to focus on those additional weeks, we'll look at this from a few different angles. First, we'll look at our AR aging, and also we'll look at pulling from our revolver. Again, as Tom was mentioning earlier, we can bring in data from multiple data sources, so being able to use Anaplan to quickly calculate through each one of our customers when each one of our payments are due down to an invoice level will help us assess what payments we're going to be bringing in, then also what payments we may not be receiving. But on top of that invoice level data, we're actually going to start to apply additional risk profiles based on the customers we have. Especially right now, certain customers are being impacted by the economy differently. So our customers that are being impacted, like say the airline industry, for example, we're not going to be expecting payments from them. But other industries that we work with, we can pull payments in from them. Now, what we'll do is we can look at here for each one of our customers, and we can start to focus on each one of our customers and what the probability of us bringing data in from each one of those customers is going to be. For example, if we focus here on customer 88, not only can we see each payment that's associated with that customer, we can also see down to invoice level detail what the aging is for each one of those customers. But more importantly, we can actually drill into the risk factor we have for each one of those customers. And that's where you're saying we can start to provide different weights on, are we actually going to receive this payment? For example, this customer 88, they are in the airline industry. And because of that, we have a low probability of actually receiving this payment. So I don't feel that we're going to be able to bring this payment in. Now, other customers we work with who may be able to bring payments in, if we start to dig through each one of our customer lists, we can start to focus on which customers we want to be able to receive payments from, or at least start being more proactive about receiving our payments. Now here, if we focus on our customer 46, we can see this is a medical supplies company. We know that this company is doing well. We've been working on bringing in this outstanding payment already. So now we know we can focus on a specific invoice out at hand, and we can include this into our payment term, into our receivables. Now to include this balance, all I need to do is check that line. And as we scroll up, we can start to see from that point on, we're no longer at that cash shortfall. So we could stop here if we want to. We may be able to look at this customer, we've worked with this customer, we can bring this data in. But especially during these uncertain times, we are not 100% sure we'll be receiving a lot of the other payments. We do want to be able to have that shortfall just in case something comes up on a weekly basis. And because of this, we want to be able to pull on our revolver to make sure that we are maintaining a minimum cash balance. Now on the right here, we can start to see is our revolver details. We can see on a weekly basis what that balance could be, as well as the borrowing capacity we have at the banks. Now here, I like to maintain a minimum cash balance of about $2 million. So we can input our $2 million. And now we can see not only what our minimum cash balance will be, but we'll also be able to see the months that it's being impacted by, as well as how much we're utilizing our borrowing. Now, as we scroll back up, what we'll be able to see is we leverage in our days payable. We look at our aging to bring in specific receipts, and we also look at our line of credit to make sure we maintain a minimum balance for each week. And now we can see not only that we're maintaining positive cash flow for each week out of our 13-week cash flow. We can see the specific points in time that we're actually borrowing and pulling from our revolver, so we can actually start to nail down when and if we want to borrow from our revolver. And also we can start to see that we pass all of our validation checks. So we can look at this and say, I'm comfortable with our overall cash flow. Now we've walked through this across a few key examples here, and this is more of that summarized cash cockpit view where we're actually looking at this, some of our customers being able to say, what are the key decisions I need to be able to make, and what are the key drivers I need to be able to pull on to make some of these decisions. In addition, we can start to see there are additional areas that we can layer into this model to be able to get more and more detail on each specific spending profile or each specific area of this cash flow, to be able to drill into those and provide more guidance as we mature or as we go to that phase 2 or phase 3 of the model that Tom was talking about initially. And that's how we've worked with a lot of our customers, bringing in data from multiple data sources. I'll pause here. Are there any questions so far?
So we have a few, but just a reminder for everybody to continue just submitting. Don't worry, we'll try to get to every one of them. But one of the questions was how easily, if this isn't how we look at our cash flow, how easily is it to change it or update it, what comes out of the box, or using this starting point?
That's a good question. That's really why we've selected Spaulding. Why we at Spaulding Ridge have selected Anaplan as one of the leading cloud platforms to work with, which is really around the flexibility. How we work with our customers is really process-enabled technology. So we can take any process that a client has, and especially with this liquidity model, be able to stand this up in a matter of weeks. For example, we have clients that are doing a very, very similar process to this that took us about 2 weeks to stand up. In addition, this process could take 2 to 4 weeks to stand up for any of our current customers, and it really depends on kind of what level of detail they want to get into.
Thank you. Yeah, that's helpful. And I mean, how long does this take? So if you have this to start with, is this going to take me? I mean, I mentioned earlier that it's weeks, but what's sort of a little bit of the process?
Yeah, and I'd say part of it depends on the level of complexity a customer wants to have. But what we've been seeing from our current customers that we worked with on this, it's been about 2 weeks to stand up, and we offer some support for about additional 2 weeks on top of that. What that allows us to do is provide some fine tweaks and across some of the scenarios in the model across that as you continue to mature with the model.
Perfect. I think that's it so far. So everybody keep submitting any questions that you do have.
Perfect. And I can hand it back over to Tom here.
Great, thanks, Dan. So just a couple thoughts before we kind of jump back into the deck. So one of the things that I think Dan did a nice job showing, is, and the question came in before about specific customer risk, right? And I think as Dan showed you, you can actually select individual customers to include in the scenario analysis. So why is that important in today's day and age? Well, a lot of organizations, as they realize that they're going to be a little bit tight on the cash side, one of the things that is not maybe part of the standard operating procedure, but in normal times, but enters the playbook, at this point in time, is the ability to go back out and potentially renegotiate, some of your receivables for quicker payment, right? So the example that Dan showed, I think there was an airlines customer with a $1.6 million receivable in the 91 plus days, bucket. So if I'm the CFO, I would say, okay, gosh, you know what? Even if I can get $1.2 million of that in, is it worth the conversation to re-engage with the salesperson who owns that account, with the account management team, if there's an account management team behind the scenes, to say, look, let's go have a conversation and see if they're willing to settle that debt for maybe a smaller amount for payment within, let's say, the next week, which is going to be more important to us to managing that cash perspective, right? Because in that maybe we don't have to go tap that additional revolver or borrowing capacity. And I think those types of decisions which can be made based off of this platform really lead to very action-oriented takeaways that the business can do to make sure that they're having a material difference or material impact to what the cash position is. And again, part of this goes to, this isn't normal times, right, with the uncertainty that we're facing, but you need a tool which is going to allow you to do that analysis very quickly and identify those potential solutions. So, we showed that on the receivable side. You can also do that on the payable side. So if you think about the money that's going out, and as much as we all want to pay everybody on time, you may have to make the conscious choice at a certain point to say, you know what? Yeah, we made this large purchase, and yet it's due in 30 days. Well, that 30 days, is unfortunately 14 days before I get that $1.6 million payment in. I'm just going to go ahead and defer it. So that means I'm going to work with my AP manager or AP team to make sure that I'm pulling that payment out of the normal course of processing, so that from a cash position standpoint, I can actually make sure that I'm keeping my head above water, or as Dan illustrated nicely, keeping that line above zero. Because I think those are the types of things when somebody says, yeah, this is it's a pretty picture, but what do I do with it? These are the types of actions that you take out of a model like this, right? And the ability to drill down into the transaction by transaction detail that's coming out of your AR system, that's coming out of your AP system. All of that is just going to help you make better decisions and frankly, put you in a better position from a liquidity standpoint. So, and again, this is just on the short-term side, right? This is just in 13 weeks. And so as we move on to the next slide and we talk a little bit more about the near term, kind of the same principle applies, which once I get into this connected planning mindset, I can start layering on top of, more and more information. So one of the things that we built into the model for the 13-week cash flow forecast, which you may not have or may not need to build day one, is this idea of what's the revolver, right? What am I attaching to what am I borrowing from the revolver, and how does that impact my cash position? We built that in for this demo just so you could say, okay, look, if I can go borrow $1 million, yeah, maybe it gets me above zero for that period of time. But what it also does is it also increases my interest payment, right? So just as I'm borrowing the $1 million to get above it for a certain week, I'm also potentially increasing my interest expense, in the following month based on the fact that, yeah, I now owe the bank for that additional borrowing capacity, which I've tapped. But when we start shifting gears and focusing a little bit more on the near term, we're going to change our perspective a little bit, right? Because it's not about AR and AP and making payroll on a weekly basis. It's really about, okay, how do I make sure that I'm thinking in terms of my whole business, and what decisions do I need to change that I would make as a normal part of my business going forward? So part of that means I need more information. And so if I think through what do I need in the near term, or what do I need to know, the first question is, how do I incorporate my sales forecast into my cash flow? Right. And one of our biggest clients is one of the Blues. And one of the projects we did with Anaplan was extracting, a significant amount of information out of Salesforce for them to allow them to forecast what their members were going to be, right? Because membership for an insurance company ends up driving almost the entire business. Because if you think about a member, there's revenue associated with that member, but also on the workforce side, there's also claims, right? So if I go from 1.2 million members to 1.5 million members, well, that's a 20% increase. And that 20 or 25% increase, that 25% increase also translates into 25% increase in claims. So if I'm doing my planning, I need to figure out beyond just from a cash flow standpoint, what are those premiums going to be that I'm receiving in, but what are those claims going to look like? And how do I begin to model those things? So the whole point about the near-term forecasting is begin to incorporate more of this operational information, be it sales, be it supply chain, into the same model that you just built for your 13-week cash flow forecast. And so we had a little bit of a taste of that with the financing revolver that Dan showed on the demo. But the power of the platform is really the ability to go out and grab these pieces of data or grab these data sets, integrated into the same data hub that you have your AR, your AP, your payroll in, and then begin to see what that cumulative effect is going to be. So to go back to the example of the sales forecast, if I incorporate my sales forecast into that same model, and I can say, okay, look, I may have two different products. One product I sell, I ship, I recognize revenue the same day, and I get paid 30 days later. Well, that's fantastic. I can bank on that fact that in 30 days I'm going to get that payment. That 30 days happens to fall within my 13-week cash flow forecast. Maybe, however, I've got an opportunity to do a very large contract where the customer is saying, look, you know what, we can pay you in 180 days. So 6 months, obviously much longer time. It's going to increase my capital requirements, potentially from an inventory standpoint, or at least from a carrying cost standpoint. Can I take that business? And so having a connected platform like Anaplan to be able to quickly look at and say, you know what, if I take this $10 million deal at 180-day terms, yeah, the revenue may look great, the profit may look great, but if it bankrupts me, you know, somewhere around day 120 because I still haven't been paid for it, I kind of shot myself in the foot. So all of this gets to, okay, how do I begin to integrate some more of this information into a connected planning platform? So it's pulling that sales information in. It's also looking at supply chain disruptions, right? And so one of the things that we're starting to see, especially now that we're about almost 2 months into kind of the pandemic, is you start to see these stories kind of bleeding out here and there about disruptions to the supply chain. And first, you know, it was the rush on toilet paper, which was, you know, a very concerted effort for everybody to say, look, I need, this is a necessity I need. But now we're starting to see it on the food side, right? We've seen the virus hit, you know, meat packing facilities across the country at this point in time. So the next shortcast that they're forecasting is around meat. So if I was a restaurant and let's say I was a steakhouse, well, how would I start modeling what kind of, you know, takeout business can I even do at this point in time if I can't get steak in the door? You know, is there a point to even bringing in the crew, the chefs and everybody else to work through that? Or am I going to put myself in a situation where that's not going to work? Same thing as I look at maybe longer term businesses, which take, you know, 6 months to fulfill, a year to fulfill. You know, if I'm floating credit for that customer or that customer is asking me to extend that credit, what is it doing to my cash position or my liquidity position as an organization? So looking at those types of supply chain disruptions and being able to model them out, just like Dan showed you with the AR and the AP model in terms of being able to adjust numbers quickly and see what the impact is to your liquidity as an organization. That's, again, the power of the platform. But it also then gets you to some of the other questions on the bottom here, which is, you know, if I recognize I've got a problem, let's say I've tweaked all the customers that I can, I push out all the payments as far as I can without disrupting my business, and I'm still short, well, what kind of funding can I go get at that point in time? And obviously there's funding like revolvers, which you may have already in place, but then there's longer term funding, which maybe to say, okay, look, can I extend that revolver credit? Can I get, you know, somebody who maybe is due interest in from a debt standpoint to forego that payment or to defer that payment in exchange for equity? So those are the types of conversations that you can begin to have from a financial leadership standpoint that you wouldn't have visibility to if you didn't have an integrated cash flow forecasting model to work through. And then lastly, you know, if you can kind of weather the storm and get back to the growth mode, you know, when can you look at bringing on employees, right? Because to think back to the first, you know, phase, right, or the short-term 13-week cash flow, I have to pay my employees every time payroll comes up, right? There's no option there. So being able to make that decision to grow and to hire new employees, I have to understand what my cash position is going to be going forward. And then same thing, you know, on the final bullet, which is, you know, when's the right time to invest in capital? I mean, one of the things that we typically see, you know, as you go through recessions is the tax policy can change to make new investment in new capital and equipment, you know, significantly more advantageous from a depreciation standpoint. And from a borrowing base standpoint, you may have the ability to go ahead and borrow that at low interest rates because the interest rates will be down. But is it the right time, or will even a small small payment potentially put you in a position where you're going to be maybe a little bit more strapped for cash, you know, over the course of the next 6 to 12 months in the near term? Any questions?
We do. We have a few actually. So first one is around implementation. And what does a typical implementation look like for this solution? I think, Tom, either you or Dan.
Yeah, I can take it. It depends on the maturity of the customer that we currently have. And a lot of the clients, what we'll actually do with this is work with them, get the requirements up front, and we'll build this out with them over about 2 weeks. Once we're comfortable with that 2 week at that 2 week point, we provide more of a support model with them, and from there we look through a few different checkpoints, whether it's around scenario planning or whether it's around, you know, automation of the data flows, being able to make that model more mature. I mean, the end goal is to get something up and running, especially in this time right now, as fast as possible. So we want to focus on that 1 to 2 week to be able to get this type of liquidity model up and standing and having a customer be able to use that quickly.
Right.
Yeah, and I would just add to that, since again, this is, you know, all about the connected planning, right, and the ability to incorporate more information. Obviously, the more you want to pull in there, the more powerful the tool gets, but sometimes it does increase, you know, slightly the implementation timeline. And you may have a different set of priorities in terms of, you might say, yep, AR and AP is good, we can knock that out in 2 weeks. But what's really important for me as an organization is maybe some sensitivity to certain commodity prices, right? And as you look at your liquidity, you know, the ability to model what the impact is of that change in the commodity price to the overall organization's profitability. Well, that's kind of a different scenario altogether, and maybe not one that is going to be right out of the box, but can certainly be built and leveraged off of this, some of the same data that we're going to pull out of, let's say, your Salesforce forecast.
So that ties into a little bit more. So how can we, I'm going to do my best. So there's a few questions in here, about like 3 or 4. So how can we utilize high level revenue forecast for the fiscal year? So looking forward without having the granularity of the data at customer level. That's the first question.
So the first question, and this is very similar to another client that we work with. So within the model itself, you can also build data inputs. So Dan showed you where you can change input drivers. You could also have a form where you could go ahead and layer in that 12-month forecast or 12-month revenue plan. So you could say, okay, you know what? If I'm going to do $50 million in January, 48 in February, 52 in March, you can layer that in and you can input that data and then have that cascade down and be cumulative with all the information that you're pulling in from your transactional systems as you go. And that's fairly typical use case for Anaplan customers, where they want to be able to more on the financial planning side say, look, I want to lay out my whole annual operating plan. I want to input that into Anaplan, great. But I want to compare that with real data, and I want to see from a transactional standpoint, or be able to drill down to see where that data, where the actuals are really coming from, so I can see where the fluctuations are being driven from. But yeah, you can absolutely do that from a data structure standpoint.
Great. And so with the cash waterfall, or just the regression analysis, this is the second question. I have one more after this. Is it embedded behind the scenes, or how does that work?
Yes, I'll let Dan take this one.
I can talk to that one. Yeah, I mean, when the piece that we walked through there was more the user experience that we're trying to define. So the cash waterfall, a lot of the calculations in that case are happening right behind that user experience we created. When we worked with that with some of our clients, their concern were, what are the triggers I can pull to see those immediate results? With working with Anaplan, the flexibility around it actually allows me to put any key information that I want to have on that user experience. So we have clients as well where we would have that cash waterfall just as part of that user experience in the front end. It's really what we've decided is important for specific customers to be able to see.
And the last question is there predictive analytics or machine type of learning that can be used to combine the high level revenue forecasting with some of the granularity, with such as OpenAR, et cetera?
Yep. Yeah, and within that model itself, we can layer in complexity as simple as data input that we showed initially, through to different levels of statistical forecasting. I think over 30 different statistical forecasting methodologies are baked right within Anaplan, up to more predictive capabilities as well. So we can really run the gamut on the level of complexity you want to be able to you want to be able to use to create that forecast.
That is all for now.
All right. So with that, we can kind of jump from the near term to the long term. So again, near term is all about incorporating more operational information into the picture. But when we start thinking about the long term, these are things and levers, frankly, which take a little bit longer. And whether it's entering a new market from a sales standpoint, whether it's making new supply chain investments, which I talked about before, such as warehouse or changing distribution networks, like those are things that don't happen overnight and really don't happen even within a few months potentially. So when you think about what you need to know in terms of the long term, it's things like, what should I do to reassess my sales organization within the new competitive landscape? Meaning, when we exit, the shelter in place and the work from home model that we're all currently operating under, does that fundamentally change what our sales team is going to look like? How do I begin to model some of that? What's the impact from an incentive compensation standpoint? What's the impact from a workforce standpoint? So being able to look through that, you're going to need more data points that are going to be integrated into the model, which is again why when we think about it from a maturity standpoint, this is really the height of maturity, when you can pull in 3 or 4 different sources of information, then begin to integrate that into a single model, which is going to allow you to figure out what you can do from a liquidity standpoint. The second question is, as I mentioned, when you think about supply chain, how and when does moving production make sense to improve cash flow? Right? If there all of a sudden becomes a longer lead time, right, or because of the arbitration with foreign currencies begins to change, where, gosh, it used to make sense to make something in China and I could stick it on a boat for 3 months and get it into LA. Now all of a sudden that takes maybe 5 months, or maybe takes longer, or there's a perceived risk on the part of our customers that something that's made overseas and that's sat on a boat for a long time is maybe at risk. How do I make those changes? Well, the ability to model out, not necessarily just even one additional production facility, but the entire production capacity of a of a global organization is something that Anaplan will allow you to do, because I can pull the right data in to make those decisions. And oh, by the way, I can change drivers like currency and lead time and all those things, which ultimately add cost to the final product or service that I'm delivering. But I need the ability to do that in context of what's my entire organization going to look like. So from that standpoint, as you kind of continue down the path, the next question was, what do I need to know? Like, there's a lot of changes that are happening in my suppliers, and to my competitors. How does that help me grow? So one of the things that you take a look at, and we talked about this with the sales organization, if you look at what your competitors may be doing in terms of exiting certain markets, right, or where your competitors may be doubling down, does that impact what you do from an investment standpoint? Well, it may depend on how much cash and liquidity you have available to make either similar or competing investments, or does it impact your strategy to say, you know what, I want to go avoid that because I don't want to be competing for talent in a high talent or a high compensation area. And so some of those things, especially from a manufacturing standpoint, where we've seen that shift over the course of time, or I'll use IT as probably a better example, we've seen the cost of development resources overseas begin to rise. They're not at the U.S. levels today, but they're certainly more than they were 15 years ago, where it was not uncommon to see development rates at $10 an hour for for very senior developer talent in India or China. Like that inflation has begun to caught up, so you have to make different decisions now. The other thing is, when you think long term, and from a financing standpoint, that the structure and options that you have in the long term are definitely different, right? If you think about, and I mentioned this at the start when I went over the maturity model, when you think about issuing potentially additional equity, right? That is the kind of thing that does not happen overnight, right? You have to typically engage with the investment bank. You have to come up with a valuation. You have to potentially be sensitive to what the current stock price is, but all of those things, which maybe your preferred method of raising additional capital for some of the investments which we talked about, they don't happen overnight, but they also have to be modeled out to figure out, what if I go out and do a secondary issuing, well, how much capital will I raise at $20 a share versus at $35 a share versus at $45 a share. So being able to quickly model some of those things on the back end in terms of what the net proceeds will be and what can be poured back into the business is incredibly important. Or the flip side of that is, well, what if I want to go the debt route, right? What if I want to issue new debt? Well, what level of debt am I going to issue? What's the dividend look like on that? How is the interest rate going to be, impacted based on where the economy is, and the ability to, again, to do that scenario analysis, relatively quickly, in terms of making those long-term decisions, so you can go down the path without wasting too much time before figuring out what the cash impact is for you. And then, lastly, and I think this is always a good question, what impact would issuing preferred equity have on my cash position? Because as you see, preferred equity a little bit different, right? Sort of the hybrid beast between the two. I'm still obligated to make those dividend payments similar to interest, even though it's equity, it's not debt, where I don't have to necessarily repay the underlying principal. Again, all of that can be modeled and built within the same model that we showed before, sort of with that simple example of accessing the revolver. But from a long-term standpoint, again, having a single tool which can incorporate all the information that I need across systems really gives me the visibility that I would want to make sort of those long-term strategic decisions. So any questions before we jump into the fireside chat?
Yeah, so there's one question. I think you mentioned Salesforce earlier, and I mean, right now, just being able to predict and understand and be as accurate as possible with sales and revenue is a game in itself, I would say, or just a question mark. So how would I do that with this solution, and then tying it with Salesforce, and then just like, how do I use both at, for what they're really good at?
Yeah, so great question. I think what Salesforce is really good at, is working with the sales team to manage what they're going to close through their sales process, right? And you can build your pipeline, you can build your pipeline reports, and all of that is great. It works out of the box, so to speak. You can get different flavors of what you need. But what it doesn't do, and what Anaplan really does for you, is it allows you then to say, okay, look, if I'm going to take that forecast, if I'm going to say, look, pull all the deals for me that are over 75% likely to complete, based on their close date, and based on the fact that I know how long it's going to take me to deliver that, when do I begin to expect the cash? Like, that's where the gap is between what Salesforce will allow you to do, which again is phenomenal for running a sales organization. But if I'm on the finance side of the house, I need some level of information that tells me, okay, you know what? If this deal closes, on this Thursday at the end of April, when can I expect the cash from that? And I think that's what we're looking at from a connected planning solution that Anaplan really does a great job of, is pulling that information in. And as Dan mentioned earlier, it's in the back end, it allows us to set those rules to say, look, let's do the calculation. Here's what the close date is. Here's what our delivery lead time is, right? Or if there's a start date for the performance of that contract, add that into the calculation to figure out when would I expect to get that receivables in, along with, oh, by the way, what are my payment terms for that customer, right? So if I go through the simple example of, let's say I close this Thursday, it takes me 30 days to fulfill. Okay, I fulfilled at the end of May. I've got net 60-day terms. So at the end of May, I'm now at the end of June, I'm at the end of July before I see that cash. So even though it may seem like, gosh, if I close this, this huge deal on Thursday, that may be, solving all my liquidity problems. Well, that'll solve your liquidity problems at the end of July. That's not going to solve your liquidity problems, in the middle of June. And I think that's the type of insight that you need to be able to get to relatively quickly when you're looking at decisions that you want to make with regard to your business, right? If and again, I hate to say this, but if sales wants to go off and sell whatever they can sell, they may inadvertently put the company in a position where they can really be, kind of strapped for cash and hurting to a large degree. So it's one of those things where, yes, by all means, go out and sell, but also understand what the impacts of what you're selling are to the financials of the organization. And interestingly enough, I think when we have this conversation with CFOs, they say, yes, this is exactly what I need, because I'm getting concerned that people are out overextending us or conceding on terms that we shouldn't. And again, to a salesperson, whether I get paid at 60 days or 120 days, doesn't matter. I'm still going to get paid, right? They're going to get paid based on that sale, for a CFO or somebody in the office of the CFO. Like, they're going to hit the panic button, because now all of a sudden I've got another 2 months where I'm potentially floating a very large dollar value if it's a large contract. And that may be the kind of thing that you not necessarily want to turn down, but you at least want to make sure you understand, how am I going to get through that period of time where I'm floating a significant amount of working capital for one transaction, if that's the case.
Yeah, and I can echo that. I mean, for looking at it from a services company and really tying the follow through to the financials, looking at your sales margins and trying to make sure that all of it is, you're able to really see it in the quarter, in the year, has been really impactful, I know, with our organization and just talking to a lot of our customers right now, especially. So thank you for sharing that, and hope that answered the question as well.
So with that, I think we've got our fireside chat coming up next.
So what are some recurring pain points you're hearing from customers regarding cash flow management right now?
Yeah, good question. I think it's, it is the unpredictability at the moment, right? And for some people that means, flying blind to a certain extent, right? Not understanding where they're exposed, looking at AR and then going to look at AP and not necessarily getting a combined picture of what their position may be. For those of you who are, I call them recovering accountants, right? And you think back to like your GAAP statement of cash flow as well, that's not going to help you figure out where you're going, because it's an entirely, retrospective instrument, right? It derives the information based on, information pulled from your income statement and from your balance sheet. It doesn't give you the forward-looking information that you need. So when customers are talking about, gosh, I'm not even sure where we're going to be at, like the ability to pull that information into a model like Anaplan and look out into the future, be it 13 weeks on the short-term cash flow, or potentially longer term with a near-term or long-term model, like those are the types of things that I can then start to model and start to figure out, what are the scenarios, what are the actions I can take to make sure that I'm maintaining my liquidity, or in some cases, making sure that I'm not going to breach my debt covenants. And that's something that I don't think people oftentimes think of, first and foremost. I think, okay, how am I going to make payroll? How am I going to pay for, the inventory and supplies that I need from an AP standpoint? But the flip side of that is, well, what happens if I breach covenants? Well, if you breach covenants, there's oftentimes impacts such as giving the debt holder the right to potentially foreclose, acceleration payments, increase of interest rates. There's a whole series of consequences. And I think that unpredictability is something that needs to be worked through, very, very, very carefully, and having the forward visibility to say, okay, you know what, maybe I've done everything I can, but still in 6 weeks, I'm going to breach. Well, if I'm going to breach in 6 weeks, I'd rather engage with those conversations, with the debt holders today to make sure maybe I can get a forbearance agreement in place. Maybe I can modify the terms so I don't have that situation, which is going to pop up, maybe at the end of July, which is the scenario we just kind of walk through. So I think, the recurring pain point, and again, it's probably a little different for each organization, but it's trying to figure out what to do without complete visibility into the situation that's upcoming, or even, to be honest, a roadmap for what the upcoming situation looks like.
That's something that I also heard that has been happening a lot is to be able to react quickly. So have you been seeing, trying, and it's sort of been the theme, but just like trying to get all this data information live, and then it's consistently just keeps changing every hour. So have you been seeing that as well?
Well, yeah. So when you have conversations with somebody who's maybe in this situation where things are tight, right, or getting tight, what they're doing, because if they don't have a model like Anaplan in place, is they're extracting that into Excel, and somebody's running through a whole bunch of scenarios, and they're coming up with the answer, and it's like, okay, great. Now I need to do that all over again for me tomorrow morning. So it's not only as soon as the next deposit is made or the next check is cut, it's not only out of date, but it's also incurring significant labor costs and churn. Plus the risk that, well, what if somebody gets it wrong on Tuesday, right? They might have gotten the model right on Monday, but then on Tuesday, they might have been out sick. I handed it to somebody else. They're not exactly sure what to do. And then you're making a decision based on completely wrong information. So I think the repeatability and having a model that's built is by all means one of the most important things that you can do. And again, this is, I call this is good discipline, whether you're talking about an uncertain time like we are now, or good times, right? Because if you're growing, you're going to have potentially the same challenge. If you're continuing to grow and you need to make investments for that growth, you're going to have a different liquidity challenge, which is the demand for your work in process, the demand for the services which you're acquiring, or the equipment which you may be shipping. All of that is going to front load the actual cash coming in. And so your ability to figure out what kind of capacity you need in order to grow with the business, it's the same discipline that will solve both problems.
Perfect. So what does success look like? I think that's the key question for everybody probably around. And what does it look like when you're not doing it right?
Well, I think the biggest metric of success is you maintain your liquidity, right? You don't end up in a situation where you have to go bankrupt. But I think from an attribute standpoint, if you look at an organization and what are the attributes that make an organization good at cash flow forecasting or cash flow management, it is being proactive, right? It's making sure that they have visibility into the situation before trouble really arises, or if trouble does arise, they have contingency plans put in place. And the example I gave earlier of, let's say, we've got that $1.6 million receivable in the 91 plus days. Well, it may be an organization which you've got an ongoing dispute over some customer service issue, and they're sitting on that payment until they feel that their service issue has been adequately addressed. Well, if I can proactively address that before I run into a situation where my cash flow liquidity is put me in a bankruptcy type of situation or an insolvency situation, I can go ahead and do that. When you talk about bad cash flow management, it is the people that are just completely reactive, right? They're looking at a situation where, like, well, hold on, like I just ran a check run for $10.2 million and I only have 8 in the bank. Like, how did this happen, right? And that's somebody who got kind of completely blindsided by the fact that their either business was growing or their obligations were growing, or the scenario which I mentioned before, where somebody sold a very large deal. The order is placed for the for the inventory, let's say, and then all of a sudden I've got to make that payment on the inventory well before I'm ever going to get paid by that customer. So again, I would say the most important thing from a successful cash flow management is being proactive and making sure that you can address the issues before they happen. The bad management would be not being, or being completely reactive and finding yourself in a situation where you have to literally grab that physical check and put it in a drawer for a week to make sure that you're not going to be bouncing checks at that point in time.
So I kind of have a wild card coming through that's additive to it, Tom. But in regards to, so if we look at different industries, and if you look at retail and then you're looking at tech, and tech's margins they're higher, they're reoccurring, they bring through, they have a little bit more cash flow ideally to be sitting on. But then the smaller margins and the ones that really like get hit faster, quicker, right away, is there different types of management for either, or is it the same way?
I think the same principles apply, but the importance of doing it is drastically different, right? If you're running a tight or a thin margin business, and tech is interesting because a lot of times tech doesn't have a liquidity problem, but they would be, essentially insolvent if you looked at what their operating cash flow actually was, because they burned through so much cash without paying attention to it, at least from an operations standpoint. But they have a lot of money that they're sitting there, either that was raised, through VCs or PE firms. But from like a forward-looking standpoint, like the importance of, and I'll give you an example. Like if you were starting a hosting company today, right, you're going to have a lot of capital that's going to be required up front to go out and build your data center, buy all the servers, invest in the high-speed infrastructure, the security, the AC, like everything that you're going to have to front load. So from a cash flow standpoint, I'm going to have this huge check that I've got to write up front, but my revenue is going to be relatively small, and it's going to come in over 3 years, 6 years, whatever the life of those contracts are. And the margins on each individual contract may appear to be, negative in some situations, but it's the cumulative effect of those contracts, which allows you to be profitable over the course of time. And it's the recurring revenue that gives you the confidence that, okay, you know what? Yeah, I mean, this is a 3-year contract. And so, if I think about where we're at today, yeah, their revenue may not be impacted as much over the course of the next few months. But if I was the CFO of a hosting company, what I would be doing is I would say, look, let me think, okay, 6 months out, like if we start to see some attrition, if we start to see some lack of renewals, what does that do? What does that do from a capacity standpoint, from a financing or from a financial perspective? Meaning, okay, maybe we were going to, add a whole nother building. Do we hold off on that because we're expecting a certain reduction, based on contracts that are being expired? Which again goes to the idea that I have to have visibility into the operations of the organization, the sales operations specifically, if I'm the CFO, so I can see, look, if my renewal rates are declining, how do I model that from a cash flow standpoint? Because if I see a 3% uptick in renewals declining today, what does that translate into cash flow next January, right? Because chances are they have 60-day outs. Nobody moves these things overnight, but I can start to model that out to see what the cash flow impact is. And again, if I've already laid out all that capital to build that facility, to hire all the workers, or hire all the tech and the security stack, and build out the infrastructure, I may not have a whole lot of spare room from a liquidity standpoint, because at that point, maybe the owners of the company or the investors were expecting that we were in cash return mode, not necessarily cash invest mode at that point in time.
Well, that's perfect. And I know we're getting close to time. So one of the last most important questions is, one, why us and how can we help? And then how do they get engaged with us?
Yeah, great question. So I think, and Dan will put up the kind of the contact slide here. But so why us? I mean, number one, these are the problems that we solve for companies of all different sizes. I mean, from small startups that are in the tech space in the Bay Area that Sarah works with all the time, to some of the largest blues organizations in North America that we're working with to help do scenario planning across millions of members. And I think when you look at that expertise and the ability to look at the problem across the organization, not necessarily just solving, well, we're really good at financial planning. If we're really just good at financial planning, we wouldn't be able to bring the insight kind of across the organization to say, look, this is what your model really needs to look like to help you answer these questions. So I think that's, it's that breadth of experience, which I think you did a nice job highlighting earlier. But then I think the second thing is the speed in which we can deliver some of these solutions. So as Dan and Sarah mentioned before, we can stand up a quick 13-week cash flow forecast model, in weeks. If you want to layer on some, key additional components, yes, that would extend that time a little bit. But it's not necessarily something that we're going to be looking at standing up for you, or starting today and standing up in October. It's let's get started today and let's see how we can quickly get you live. And even if it's phase 1 just to do AR, AP, and payroll, and phase 2 is, okay, let me layer in my revolver or my borrowing capacity. What does that then begin to look like? Like those, it's that speed to value that I think we do a great job of bringing to the table with a best-in-cloud solution like Anaplan.
That's great. And thank you, Tom and Dan. Really appreciate it, and everybody that participated. So we're going to send out a follow-up with our information, but also some content and links. We've been putting a lot around this topic. And thank you, everybody, for your time.